video, I am going to share with you 4 Singapore REITs that have managed to grow their distribution per unit despite the tough economic environment. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and I've been covering topics such as stocks, finance, CPF, and basically everything related to growing your wealth. The investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've also covered over 600 videos and over 280,000 watch hours as of November 2024. I also occasionally focus on topics related to regional or world economy. 2024 has been a challenging year for the REIT sector. Despite recent interest rate cuts, income investors are worried about a higher for longer interest rate environment. This tough situation has hit many REITs hard, increasing their borrowing costs and putting pressure on their distributions. However, some REITs have managed to increase their distribution per unit, DPU, despite these challenges. Today, we'll look at 4 Singapore REITs that have grown their DPU in the face of these headwinds. Parkway Life REIT. Parkway Life REIT, or PLIFE REIT, is a healthcare REIT with a portfolio of 64 properties across 3 countries. It owns 3 hospitals in Singapore, 60 nursing homes in Japan, and strata units in a specialist center in Malaysia. Now, this REIT is interesting because it focuses on healthcare properties across Singapore, Japan, and soon, France. We're talking hospitals, nursing homes, the kind of stable assets that tend to hold up well even when the economy gets a little bumpy. Looking at their performance for the first 9 months of 2024, we see a bit of a mixed bag. While gross revenue and net property income took a slight dip, around 2%, due to the yen's weakness against the Sing dollar, it's important to look at the bigger picture. Currency fluctuations are a factor with overseas investments, and it's something we always need to consider. But here's the kicker. Despite these currency headwinds, PLIFE REIT actually increased its distribution per unit, or DPU, by almost 3%. This tells me they're managing their portfolio effectively and prioritizing returns for US investors. They've also kept their debt levels at a manageable 37.5% and secured incredibly low borrowing rates, averaging just 1.36%. This low cost of debt is a huge advantage in the current rising interest rate environment. Now, what really caught my attention is PLIFE REIT's recent move into France. They're snapping up 11 nursing homes from Domus Vi, a major player in the European healthcare sector. This is a big deal, investors. Not only does it diversify their portfolio geographically, but it also opens up a whole new market for growth. They're projecting this acquisition to boost their DPU in the first half of 2024 by close to 2%, which is definitely something to keep an eye on. Expanding into a third strategic market like France shows that PLIFE REIT is not just sitting still. They're actively looking for opportunities to grow and increase value for their unit holders. This kind of proactive management is what I like to see in a REIT. It indicates a forward-thinking strategy and a commitment to long-term growth. So, while the short-term numbers might show some minor fluctuations due to external factors, the overall picture for PLIFE REIT, with its strategic expansion and focus on stable healthcare assets, looks pretty solid. Mapletree Industrial Trust. Mapletree Industrial Trust, or MIT, is an industrial REIT with a portfolio of 56 properties in the US, 83 properties in Singapore, and 1 in Japan. As of September 30th, 2024, MIT's assets under management stood at $8.9 billion. This REIT's got a pretty impressive spread of properties. We're talking 56 in the US, a whopping 83 right here in Singapore, and even 1 over in Japan. That's a lot of real estate. Now, as of September 30th, 2024, they were managing a portfolio worth a hefty $8.9 billion. That's a big number, showing just how much MIT has grown. Looking at their performance for the first half of fiscal year 2025, things are looking pretty good. Gross revenue jumped by 3.5% to $356.7 million, and their net property income, or NPI, also saw a healthy increase of 2.9%, reaching $267 million. Most importantly for us investors, the distribution per unit, or DPU, which is essentially the dividend we receive, went up by 1.3% to $0.068. This tells us that MIT is generating more income that they can distribute to unit holders. Now let's look at some of the key metrics that tell us how well MIT is managing its portfolio. Their occupancy rate ticked up slightly to 92.9%, showing that their properties are generally well leased. This is important because higher occupancy means more stable rental income. They're also managing their debt quite well, with an aggregate leverage of 39.1%. This is a reasonable level of debt, and importantly, only 5% of their loans are coming due in the current fiscal year, meaning they don't have a big refinancing hurdle to jump over immediately. Their borrowing costs are at 3.2%, and they have a strong interest coverage ratio of 4.7 times. This means they're earning almost 5 times the amount of interest they need to pay on their debt, which is a good sign of financial health. Another positive point is that they're keeping their tenants happy, with a solid tenant retention rate of 73.2%. And even better, when leases are up for renewal, they're managing to increase rents by an average of 10.7%. This positive rental reversion shows strong demand for their properties. CapitaLand Integrated Commercial Trust. CapitaLand Integrated Commercial Trust, or CICT, is a retail and commercial REIT with a portfolio of 26 properties in Singapore, Germany, and Australia. As of December 31st, 2023, CICT's assets under management were $24.5 billion. This REIT's got a pretty impressive portfolio with 26 properties spread across Singapore, Germany, and Australia. We're talking a massive $24.5 billion in assets under management as of the end of 2023. Now, diving into their performance, things look pretty good. For the first half of 2024, they saw a 2.2% jump in gross revenue, hitting $792 million, and their net property income, or NPI, climbed even higher by 5.4% to $582.4 million. That's solid growth. And for us investors, the distribution per unit, or DPU, also went up by 2.5% to $0.543. This means more money in our pockets, which is always a good sign. Looking at their third quarter update for 2024, the positive momentum continued. They reported a 1.7% increase in gross revenue, reaching $397.9 million, and NPI also saw a healthy 5.4% rise to $289.8 million. One thing I always look at is occupancy, and CICT's got a strong 96.4% committed portfolio occupancy. This means their properties are mostly filled with tenants, ensuring a steady income stream. Plus, with over 3/4 of their borrowings on fixed rates, they're less exposed to rising interest rates, which is a smart move in the current economic climate. What's also interesting is that they've been achieving positive rental reversions, 9.2% for retail and a whopping 11.7% for their office spaces in the first 9 months of 2024. This shows they're able to command higher rents, further boosting their revenue. They're also actively enhancing their assets like the IMM building here in Singapore, which has already achieved full occupancy for the first 2 phases, and Galileo in Germany, with enhancements expected to wrap up in the second half of 2025. These initiatives should further strengthen their portfolio and future performance. Their AIMS APAC REIT. AIMS APAC REIT, or REIT, is an industrial REIT that owns a portfolio of industrial, logistics, and business park properties. The REIT has 25 properties in Singapore and 3 in Australia. This REIT focuses on industrial properties, which is a pretty hot sector right now, especially in Singapore and even down under in Australia. Looking at their performance for the first half of fiscal year 2025, we see some encouraging numbers. Gross revenue jumped up by 7.7%, hitting $93.5 million, and net property income, or NPI, also saw a healthy rise of 5.1%, reaching $67.6 million. Now, the all-important distribution per unit, or DPU, inched up slightly by 0.4% to $0.0467. While it's a small increase, it's still positive movement, which is always good to see. What's also impressive is their portfolio occupancy rate, sitting high at 95%. This means they're keeping their properties filled, which is crucial for consistent income. On top of that, they've managed a strong positive rental reversion of 16.9%. This basically means they're getting higher rents on renewed leases, which is a big win for boosting revenue. Now, let's talk about the financial health of REIT. They've got a low aggregate leverage of 33.4%. In simpler terms, this means they aren't overly burdened by debt, which is a good sign of financial stability. Their blended funding cost is at 4.4%. With interest rates being a hot topic, it's worth noting that about 74% of their loans are on fixed rates. This is a smart move because it helps to shield them from the full impact of rising interest rates. Looking ahead, REIT's management isn't just sitting still. They're planning strategic investments and developments, and they're also focusing on active asset management to keep those rental reversions coming in. They currently have 2 asset enhancement initiatives underway. These initiatives are designed to boost organic growth and further increase the REIT's top line. So, overall, APAC REIT seems to be in a pretty good position, navigating the current market conditions effectively. Conclusion. All right, folks, Iggy here, and let's talk about some REITs that have been absolute rock stars lately. We're talking about those REITs that haven't just survived the recent economic roller coaster. They've actually thrived, managing to boost their distributions per unit, or DPUs, even with all the headwinds blowing around. Now, how have they pulled off this amazing feat? Well, it's a combination of smart moves, really. Think strategic acquisitions, picking up properties that fit perfectly into their portfolio and generate solid income. Then there's asset enhancement initiatives, or AEIs, which is basically like giving their existing properties a makeover to attract higher quality tenants and command better rents. And of course, you can't forget the importance of savvy financial management, keeping costs in check and ensuring a healthy balance sheet. These factors combined have allowed these REITs to navigate the tough times and deliver consistent or even growing returns for their investors. It's like they've found the secret sauce to REIT success in Singapore's dynamic market. Let's dive a bit deeper into what these strategies actually mean for us investors. Strategic acquisitions aren't just about buying any old building. It's about identifying properties in prime locations or with strong growth potential, properties that can contribute positively to the REIT's overall performance. AEIs, on the other hand, can range from simple renovations to major upgrades, all aimed at increasing the property's value and rental income. For example, a REIT might upgrade its building's lobby, install energy-efficient systems, or even reconfigure the space to attract new types of tenants. These improvements not only attract better tenants, but also allow the REIT to charge higher rents, which directly translates to higher DPUs for US unit holders. And finally, smart financial management ensures that the REIT has access to funding for these acquisitions and AEIs at competitive rates, while also maintaining a healthy debt profile. This careful balancing act is crucial for long-term sustainability and growth, especially in a volatile economic climate. It's a testament to the management's expertise and their commitment to maximizing value for investors like you and me. If you guys enjoyed this video, then you're going to love our video on 3 Singapore blue chip stocks hit all-time highs, time to buy. In that video, we dive deep into some of the most reliable dividend-paying stocks in Singapore's market. It's a perfect complement to this REIT discussion, especially if you're looking to diversify your income portfolio. Check it out to learn more about building a robust dividend strategy in the current economic climate.